Hi, Jonathan York, Bay Financial Partners, looking at the investment markets. No real surprise from the Fed. They've increased the Fed funds rate by another 75 basis points, taking the target range now to 3 to 3.25. What is interesting now, they're talking about a peak of around sort of 4.6, and that'll be sort of mid sort of 2023. Now, what they are very keen to stress is that a rate cut is really off the table at present, because what they're really worried about is sort of a sort of fallback to the sort of early 80s, where the Fed was in a interest rates hiking cycle in the late 70s, and then sort of eased off, hoping that inflation was sort of beaten, but it wasn't. It came back pretty strongly. And the Fed certainly doesn't want to see history repeat itself. Potentially the Fed might be prepared to sort of sacrifice their sort of shallow recession now in sort of 2023 in order to try and beat inflation and get it under control. But that's certainly going to be a pretty fine balance. It's really, the Fed has sort of, although they haven't admitted it, sort of come out and said really that, that they were sort of slow to get to the party here, well behind the eight ball, and sort of, the talk that inflation was just sort of transitory was really way off the mark. Now the 10-year currently is still around 350. But against that, you've still got a pretty robust US economy, and really something's got to give, really, because you've got record low unemployment, and you've got to start to see those numbers start to increase now on the unemployment front, to start to take some of the heat out of the economy. Although certainly some of the inflationary pressures are starting to ease out there. Oil is now off sort of 30% from its recent highs. You're starting to see food commodities come down as well, as you're starting to see some of those shipments coming out of Ukraine. But in his latest speech from President Putin, which sort of, almost sort of disintegrated into a bit of a rant, he's now mobilized 300,000 more troops to go into Ukraine. And even how the veiled threat of potential sort of nuclear weapons being used. Now, this clearly seems to be a sort of all-in last sort of call, really, to try and save face, because really Russia has been humiliated at every turn in this war. Although according to Russia, it's not a war; it's a special military operation. But now stretching over 200 days, when he expected it to be all over in probably less than a week. And Putin really has been backed into a corner now, and really just trying to save face at any cost. Now, certainly what could be quite interesting is, really China's sort of role in this, because, China is, although it hasn't supported Russia, it hasn't come out and denounced its actions either. But in a rare show of unease, Xi Jinping did make comment about the volatility in oil. Obviously, that has some major implications for the Chinese economy. And with that Chinese growth struggling now, for the first time in quite a while, it looks like the major developed countries in Asia will have a higher GDP than China. So that could just be an interesting thing to watch, really, because certainly China starts to bring up a little bit of a sort of weight to bear on the Russian situation. Then Putin will probably have to sit up and listen. Now, sort of stressed oil has backed off, currently around sort of $85 a barrel. And if it can hold around those sort of levels, then potentially quite a bit of the inflationary pressures will be taken out of the economy. It's just going to take a while for that sort of filter through. It's not going to be an overnight fix. Now in the UK, obviously, it's been all about the sort of funeral for Queen Elizabeth II, but really, strange about that sort of galvanised the country, really, and sort of everyone appears to be pulling together for the right reasons. You've got the new PM, Liz Truss, has come in and announced some, some pretty major sort of policies for energy costs, etc., and that might just help pull the country together. But certainly looks like it's going to be a pretty tough winter for the UK. Now Europe's still scrambling to try and get enough sort of gas stored and sort of supplies set up for covering the loss of Russian gas over the winter months that are coming up. And really, potentially, could just depend on how severe the winter is. If the winter is pretty mild, then it looks like the Eurozone will probably get through unscathed. But if it is a particularly severe winter, then there's going to be quite a bit of pressure there on the energy and that sort of gas demand, and that could have some major implications because certainly supply is going to get stretched. Now in Australia, the recent reporting season was really pretty good. We saw dividends of around $44 billion being paid out, and more importantly, that's an increase of around $6 billion from the previous reporting season. Certainly given the support that seems to be coming out of the central government in China as well in terms of infrastructure spend and support for the economy, that's obviously helping sort of minerals and commodities, and that's in turn is obviously helping the Australian economy. So despite the rate increases, and certainly we still expect further rate increases coming through from the Reserve Bank of Australia, the Australian economy looks in pretty good shape. Now here in New Zealand, there was a little bit of better news out there last week with the GDP results. That came in at 1.7%. Now that was much stronger than the estimated sort of 1%, and it's just going to be interesting now to see how it does sort of trade through, because certainly the Reserve Bank is still looking at increasing interest rates. You've still got rapid inflation out there. You've got an OCR of 3%. That's expected to go to 3.5 at the next meeting. And interestingly, one of the major high street banks has come out now and revised its forecast for the peak OCR to 4.75 from 4. The case, you're looking at a mortgage rate with a 6 handle on that. Quite interesting, because if you look back sort of 12 months ago, mortgages had a 3 handle. 12 months down the line now, you're looking at a 6 handle. that obviously has some pretty major implications out there for the discretionary spend of the New Zealander public. We're now getting obviously closer to that election now. We're now sort of around 14 months away from the election. And now, certainly with house prices, continuing to fall as pressure comes on interest rates. On the flip side, though, the positive side, TD rates are obviously increasing, but they're nowhere near increasing as much as the interest rate rises. So, it is still pretty tough out there for savers, but if you are looking for income options, go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we look forward to speaking to you soon.